Hi, Planty here, and I've got the Alpha Futures cap on today, and I'm joined by Pep, who's a bit of a novice in this game. He's excellent in the CFD space, so hopefully he's going to have some interesting questions that not only helps him, but helps you at the same time. So without further ado, back to the Goldfish Bowl.
Let's get into it. Right, fundamental traders don't need to understand technical indicators.
I'm forever being asked that. I can't get away from it.
Common question.
Obviously, for me, I totally disagree with the premise. Fundamentals and technicals live together in the same space. At any point, one might be in the ascendancy to the other, but I think you need to keep on top of both to know when to react. And I always talk about it as being that classic adage of not knowing what wood you're in, but you know all the trees. Mm-hmm. So to me, you need to know the background, and then the technicals take care of themselves within that.
Exactly. Whether you're trading futures, stocks, CFDs, commodities, you need to understand.
The price action is all the same. And as I'm sure we'll get onto later, it's the mystical world of futures. It's still the same generic instrument. It's just slightly differently dressed up. But, and if anything, and we'll talk about futures, have a lot of information in the trading that goes on in those that people should be already looking for.
So is fundamentals more important in futures rather than CFDs, or again, like I said,
it's probably a good stage to bring that in. A lot of the time on my chat, and I've got people to look at gold in a different way. Gold's always been a big futures world contract, mainly because it's a commodity, and you've got all the actors are in there. You've got the speculators, you've got people who actually mine it and want to hedge the price action going forward, and various people with different roles in that whole spectrum from between the hedgers and the speculators and blah, blah. So you've got different volumes going on, different players, which is why when you look at commitment to traders, they're split into those different, and that's something that everyone should look at. CFTC data every week is released on a Tuesday and tells you where the managed funds are and the speculators and the non-professionals and the actual people who produce. You'll know what their open interest is, their longs and shorts.
Where can you go to find that information?
So you literally go on to the CME website and you get links to all this. So if anything, if you're going to trade, in the trading in general, I think you should always be looking at what's going on the CME website, because they give you so much information about products, and then they give you all the futures-based stuff as well. And that is a go-to. And if you're going to trade in the futures world, no futures company will, like an Alpha Futures included, will tell you the full contract details of what you're trading in, purely because it's controlled by what is on the CME. We're literally following contracts of CME, CBOT, so the Chicago Mercantile Exchange, Chicago Board of Trade. These are the big futures exchanges in America. Okay. So they create the rules. So if you want to know what the contract is, it's their contract. Go and look at their details.
What's CME? What does that stand for?
That's Chicago Mercantile Exchange.
Right. Okay.
So it's just the names of people that run the exchanges, basically, and they've come through a couple of mergers over the years and that sort of stuff. But like futures were always existed since financial markets came around, in the last couple of 100 years, because people want to sell forward their price. It literally came from producers of goods wanting to guarantee a price in the future. So you'd have to pay for the right of creating that price. There'd be, how much it costs to borrow money to produce that instrument. That's what created forward prices. And then it developed into futures because people wanted to make it the same price and same quantity so that everyone could trade with each other and know they were going to get exactly the same stuff delivered on the same days, blah, blah, blah. Now, what a thing people forget is Forex didn't exist until gold came off the gold standard. Mm-hmm. So that all came in the 70s. So then you got financial futures came through. Now, there had been a little bit of index futures and forwards, but this exploded the whole thing. So you created a lot of generic instruments. But the reason I started off with gold there is that there's certain rules about delivery. Gold is a commodity that people buy and sell. For a long time, most of the trading was just in financial instruments of gold. So you get settled in cash. But within that, there are people that want to be delivered the gold. But for a long time, central banks have been selling gold because there's no gold standard. Now you've seen what's happened in the real world, the de-dollarization arguments, everyone printing money, weakening their money supply. So gold has suddenly become more interesting. The rules changed, something that I've been going on about for months. On the Bank of International Settlements made gold the only other reserve asset currency that you could hold. So the dollar is the main reserve asset, which is why people around the world have owned it. Post-Ukraine, this de-dollarization, using the dollar as a weapon, stealing the money off Russia, using it, etc. China have got panicky, as has everyone else. So all the central banks now are going, we need to own gold rather than the dollar. And because it's been made a reserve asset currency, to have it as a reserve asset, you have to own 85% of it physically.
Okay.
So this game has changed. Everyone's still trading around in gold thinking you're going to get settled in cash and blah, blah, blah. If someone asks for it to be delivered, you've got to deliver it. And if you want to stand against that contract, both sides have got to put the money up. So it becomes quite onerous to trade in gold. So this is why gold is up 25% this year, because everyone's buying the physical. Literally, when they want it, it's got to be delivered. So whoever's sold them the gold have got to find it, which is a lot different from how we're doing futures in this, where we're just trading in cash settlement. But the prices are being affected by what's happening in the actual real world.
Okay.
So net to get to an answer for you is that there's so much information from the real players in the real world that are hidden in that price. And then a CFD price will be driven off really what the gold price is. The spot prices are always driven by.
And with alpha futures, is there a go-to asset most people gravitate towards? Because I know in the CFD space, it's euro, dollar.
And euro dollar in the real futures world is, I think it's $1 trillion a day gets traded. It's absolutely massive. A lot of criticism you see in the CFD world is it all depends on the leverage that's allowed by the actual prop firm. And we know that our own S&P contract is not easy to trade with the leverage that we give it. Whereas if you come over to alpha futures, it's set in terms of contracts. And we'll go on to that, I'm sure, in a question later. But because it's a set standard that you're trading, you suddenly get more leverage as you trade in the leverage that you would in the real world. So, we know in our prop space, people will trade NASDAQ, DAX, and the Dow. Now you can trade with us at Alpha Futures in the Dow and NASDAQ and S&P, but all in their right amounts, whereas you wouldn't really trade S&P. It's difficult for the leverage that we have on Alpha Capital as opposed to Alpha Futures.
Yeah, makes sense. Most traders fail because they are too impatient and impulsive. I think that's one element of it.
Yeah, I mean, it's difficult, isn't it? Because you don't want to be too slow. Sometimes it can be just as bad to be a little bit too overcautious and too wary.
Yeah, people stay on a demo account, for example, for too long. You need
a
bit of skin in the game.
Skin in the game is big. It needs to sort of count, doesn't it? But I think what people are thinking there, you're impatient. You put a lot of work into finding your setup. Nothing is guaranteed. Nothing moves in a straight line, and therefore you go through a permanent test period where it's in a consolidation pattern. Maybe you keep breaking out, keeps getting supported. You can't quite find the direction, and
people struggle with break-even stops. You need to give it time.
You need to give it time.
A bit of breathing room, like a higher high, but then after the new high, you've got to wait for that pullback, and that pullback might hit where your entry was. So that's when you just got to maintain your bias, and you've got your stop where it was originally for a reason.
But you can you can dress it up too much. All these things fall back on that kind of fear of missing out. The fear and greed index is the one that is really the most important of all things in trading. It's literally, you wanted to buy it, you didn't buy it, it's going up, right? I've got to buy it, and then it comes down, and then you get scared. And you've probably gone too big because you think you were missing out. All the psychology comes in, whereas you just got to look through it, cut out the noise. Right, I've got a plan. The stop loss is there. The stop loss is staying there. It may trail upwards if you're moving into profit. And I don't really see that there's a problem once you're in profit of moving that up to make sure that risk management and capital gains. At that point, you kind of think it's broken out. If it does come back, I think we've talked about this before, is that it's time to reanalyze if it comes back to your starting point again. Is that trade still valid?
Yeah, exactly. And also, some people have the mindset where as soon as they jump onto the charts, they need to place a trade. But again, like you've just said, you need to wait for your setup. You have a strategy and edge for a reason. And if you're not following that and you just think, jumping on the charts doesn't equate to taking a trade, your strategy and edge do.
That's right. I mean, there's nothing more annoying, and I've got people talking to me all day and tell me about basically most of the time they're winners, and it's very frustrating to listen to. And you're thinking, how the hell am I missing out on this? And that surely is obvious. And the novice is going to come into it and go, well, I might as well just buy and carry on and deal with it once I'm long. But where's the strategy? Where's the edge? You're just literally putting yourself into stressful positions and time that would be better off spent actually analysing and looking for an opportunity. You don't have to stay in the same instrument. You can go into other ones, or you can look at different time frames. And that's when I start something fresh, I'll go out to the higher time frame and I'll come in on 4 or 5 of them just to see where each one is. Because again, that sits with how I look at things. That whole Elliott wave things are waves within waves. That to me is the whole definition of time frame trading. Is that there's a different time frame, a different wave within a wave. So the whole thing can be going up, but for the next 2 days it's going down. That is good preparation and good psychology preparation. That might mean that I either stay neutral or I don't get involved for 2 days. Or it might just mean I stop loss that appropriately now because I know that there's going to be some noise that I don't want to get me out of this trade for the next couple of days.
In regards to the charts, you mentioned the charts. Is it the same as the CFD space, or is there, say, for the S&P 500?
That's a really good question.
Futures chart.
Really good question. And in fact, you were asking earlier about what are the advantages of futures trading and trading futures at alpha, and that is the fact that we only trade the front month. What do you mean by that? So futures,
I definitely know what that means. Yeah.
So the futures I said are literally priced forward into future. So if you want to lock in what the price is going to be in 3 months' time, you can trade a future. What would be? Would that be December? Or you might have something that you produce coming out in November, so you might want to hedge that. And equally, it could be a position. You want to hold a position for 2 months and you want to be long now, but you want to sell it in November. Then you can be short and long at the same time. But there's a time difference. They call that a calendar spread. But we don't get involved in that because that's all like too technical. We don't want you to get confused. The biggest issue when people come to start doing futures is, what the hell do I trade? There's 20 different months here. Which one is the one that I want to trade? So what you want to do, by definition, if you're looking to trade an instrument, you want to be trading where the volume is. So what we do is we put you on the most active contract, which generally is the nearest one. But a lot of these contracts have 3 months. The most popular contracts in futures in general are the quarter ones, which is March, June, September and December. And then the instruments that have intra-months, they're generally ones that have producers that want to hedge in particular time. The majority of financial futures are March, June, September and December. And that brings up something you probably hear in the news, triple witching, quadruple witching. You hear about that at the end of every quarter and everyone goes, what the hell is that? And that is literally the expiry of the most active futures at any one time. So this, interestingly, we're very close to the end of September. So the Forex ones, the FX ones, expired on Monday. So they would roll to the next contract. The most active would be December by definition. And then the sort of index ones, they expire on the third. So that's the third Monday for the FX, the third Friday for all the index ones. So round about now, because we're in the week of the third Friday, the volume of the current September contract will be getting close to the December one, because most people want to be in something that is going to be enduring and there for the next 3 months. So last night I had a position on the NASDAQ. I suddenly looked up and God, what's the news flow? It's like it's just jumped 200 points. So because it's forward, you've got to price in the cost of holding it. So that price is, so that by the look of it, there's 250 points of difference between the September contract, which is almost spot because it's nearly expired, and 3 months worth of future is 250 points higher on the NASDAQ. So all of a sudden, if you're in the real world, you'd have to go from one contract to the next one. There's a thing called a roll, a price in. So we make sure that you haven't got to get involved in any of that technical at Alpha. We do it for you.
Okay.
So because we close you out every day, and we'll talk about that in a minute. Yesterday, trading in the September contract, you get closed out, whatever, at the end of the day. Tomorrow, or which is now today, we're trading the December contract. The price has changed, but you haven't got any issues with the roll because you were already closed out. In the real world, you'd have to pay a price to go from one to the next. Or if the price was in your favour, you might actually receive money from going one to the next. But again, these are all technicals that are all there to make people out in the real world think, God, I'm not trading futures because there's so much to do. We've taken a lot of that out of it for you.
Well, that was going to be one of my questions is, I'm an alpha capital prop trader. I'm looking to get into alpha futures. What resources do I need to brush up on? Is there any particular website where it's going to teach me all this?
Yeah,
or
so
is that supplied in the Discord?
So there's we've got a Discord, which replicates what we've got on the prop side, but from a futures perspective, by all means, get yourself in there and learn. But a lot of this is the nuances of it. You need to go and you look at the CME website, the Chicago Mercantile Exchange. Not only that, they've got some demo trading tools on there now. If you sign up on there, you get access to a lot of really funky stuff. And something that I watch a lot of the time and I encourage people to do is this, there is the CME Fed Watch tool on there, which literally looks at the short interest, the short dated futures, the 30-day Fed futures. So that is where, when you hear people in the media talking about there's X percentage chance of this interest rate move and that one, that is where the majority of the money in the world is betting on where the interest rates are going. So that's a fantastic free tool they've got on there. But also there's a free tool on their website where you can practice trading futures. And because by definition it's centralized, as we said earlier, all the data is from them, you need to go on there to look at what the contract sizes are. A really good page, markets page on CME, and you can drill down into all the instruments, gives you a calendar list of when all these things expire, and crucially, it tells you what the volume is per day and a thing called the open interest. The open interest is how many contracts are live, long and short, and what the net difference is. But it shows you the volume, and you'd have seen yesterday how close the volumes were between NASDAQ September, NASDAQ December. So you would be anticipating that flip over into the new contract.